The company secretary serves as the principal administrative officer responsible for ensuring that the company complies with its statutory obligations and internal governance procedures. Under the Companies Act 2006, every public company must appoint a company secretary, whereas private companies are not legally required to do so, although many choose to appoint one voluntarily for administrative efficiency. The secretary of a public company must satisfy specified professional qualification requirements. The individual may qualify through having served as secretary of a public company for at least 3 of the previous 5 years, or by being a solicitor, barrister, or member of recognized professional bodies such as ACCA LW, ACCA, SHIMA, ICSA, or SIPFA. Alternatively, a person whose qualifications or experience demonstrate appropriate capability may also be appointed. The secretary is generally appointed and removed by the directors, reflecting the administrative rather than managerial nature of the office. The company secretary performs numerous statutory and administrative functions. These include ensuring that company registers and statutory records are maintained, preparing and filing required returns with the registrar, organizing board and shareholder meetings, preparing agendas and minutes, issuing notices of meetings, and countersigning documents to which the company seal is affixed. These responsibilities ensure that the company satisfies its legal obligations while maintaining effective corporate administration. The secretary also possesses authority to bind the company in certain administrative contracts. In Panorama Development v. Fidelis Furnishing Fabrics, the court held that contracts entered into by a company secretary for services normally associated with the office were binding upon the company, even where the secretary acted improperly. The decision illustrates the principle of implied authority, recognizing that third parties may rely upon the secretary's apparent authority when entering ordinary administrative transactions. Auditor. The auditor performs an independent oversight function by examining the company's financial statements and reporting to shareholders on whether those statements present a true and fair view of the company's financial position. Auditing therefore strengthens investor confidence and promotes transparency within corporate reporting. Auditors are generally appointed by the shareholders through an ordinary resolution, although the directors may appoint the first auditor following incorporation or fill casual vacancies arising during the auditor's term of office. To qualify for appointment, an auditor must belong to a recognized supervisory body and satisfy the relevant eligibility requirements. To preserve independence, an auditor cannot be an officer or employee of the company, nor a partner of an officer or employee. The duration of appointment differs between public and private companies. In a public company, the auditor remains in office until the conclusion of the meeting at which the accounts are presented unless reappointed. In a private company, the appointment generally continues from the expiry of the statutory circulation period until the corresponding period in the following year and is often renewed automatically unless specific statutory exceptions apply. Where a company fails to appoint an auditor when required, the Secretary of State may exercise statutory powers to make the appointment. The auditor's principal duty is to audit the company's accounts and report to the members on whether proper accounting records have been maintained and whether the financial statements agree with those records. Auditors possess extensive statutory powers, including the right to access books, accounts, and vouchers, obtain information from company officers and employees, and receive notice of, attend, and speak at general meetings. Failure by company officers to provide requested information may constitute a criminal offense unless compliance is not reasonably practicable. Duties, resignation, and removal. The removal of an auditor is governed by statutory safeguards designed to preserve auditor independence. An auditor may be removed by ordinary resolution with special notice at a general meeting, and removal cannot be effected by written resolution. The requirement for special notice ensures that members receive adequate opportunity to consider the proposal before voting. An auditor may resign by written notice to the company, accompanied either by a statement explaining the circumstances surrounding the resignation or by confirmation that there are no circumstances requiring the attention of members. Where significant circumstances exist, the company must send copies of the resignation statement to the registrar, shareholders, and debenture holders. Furthermore, the resigning auditor may require the directors to convene a meeting within 28 days to explain the reasons for the resignation directly to members, thereby promoting transparency and shareholder awareness. Types of meeting. Company law recognizes several forms of corporate meeting through which shareholders exercise governance rights and approve major corporate decisions. The annual general meeting, AGM, is compulsory for public companies, which must hold a meeting within 6 months of the financial year end under Section 336 CA06. Private companies are generally not required to hold AGMs. The AGM normally considers the annual accounts, appoints auditors, elects directors, and declares dividends. At least 21 days' notice must be given unless all eligible members consent to shorter notice. Failure to hold an AGM may result in fines, and members may apply to the Department for Business and Trade to convene the meeting. A general meeting, GM, may be held whenever corporate business requires shareholder approval. Public companies must convene a GM where a serious loss of capital has occurred, meaning net assets have fallen below 1/2 of paid-up share capital. At least 14 days' notice is normally required, and the agenda is determined by the person requisitioning the meeting. Finally, a class meeting is convened where holders of a particular class of shares must consider matters affecting their class rights, such as proposed variations of dividend or voting rights. The meeting follows procedures similar to those applicable to general meetings, with a quorum requiring 2 persons holding or representing by proxy at least 1/3 of the nominal value of the issued shares of the relevant class.